This is a condensed version of our presentation to the Washington Multifamily Housing Association on September 28th. We titled that presentation, How a Conspiracy Theory Created the iHome, just in time to capitalize on the geyser effect. We won't tell you that story here, but we will highlight some of the important trends. This chart shows the market vacancy rate, which excludes vacancies in new construction still in initial lease-up. The market rate has bounced between the high 4% and the low 5% range for the past 2.5 years. It's currently 4.8%. By comparison, the gross vacancy rate, which does include vacancies in new units in initial lease-up, is currently 5.5%. Even though vacancies have edged up a little, they are still low, so rents have climbed, making up for their losses in 2009 and 2010, and then some. Rents are up 4% in the past 12 months. Most of that increase took place since March. Low vacancies and rising rents. Now, that's something that gets investors' attention. This chart shows monthly sales volume and the trend line. Sales activity bottomed out in 2009 and has risen steadily since then. This year is already the 6th best year ever in our region, and we've still got 3 months left. This year will end up being the 5th highest volume year. More buying pressure means higher prices. Prices peaked in 2008 at $126,000 a unit. Then they bottomed in 2010 at $110,000 a unit. So far this year, they average $132,000 a unit. That's a 20% gain in just 2 years. Prices have climbed more than twice as fast as rents, and the chart shows they are moving higher monthly. So, with significant buying pressure moving prices up faster than rents, that results in lower cap rates. Cap rates reached an all-time low point in 2007, averaging 4.8% that year. Then they rose during the recession, peaking at 6.25% in 2010. They've been falling since then and average 5.7% so far this year. The chart, though, shows they have been trending even lower recently. Cap rates are lower in Seattle, averaging 5.1% this year, and 100-unit and larger properties built in the past dozen years in King County are averaging cap rates of just 4.5% this year. Although buying pressure is pushing cap rates lower, there is another factor, and that's low interest rates. Back in 1990, cap rates were around 9% or 9.5%, and so were interest rates. In 2000, cap rates were close to 7.5%, and so were interest rates. Right now, cap rates are close to 5.5%, but interest rates are much lower, suggesting there's room for cap rates to fall even more. A healthy rental market got investors' attention. Add to that a healthy investment climate, and now you get the attention of developers as well. Last year, developers opened just 1,500 units. That's the lowest in 40 years. This year, they're going to open almost 6,000 units, which is close to the most we've seen in any year in more than 20 years. The chart shows an interesting trend. There was a huge development boom in the late 1980s, fueled by the tail end of the baby boomers. A smaller one in the late 1990s, fueled by Gen X, which is a much smaller population group than the boomers. And we're heading into another one, to be fueled by Gen Y, which is almost as big a group as the boomers. But more about that a little later. Another interesting trend right now is the size of apartments is shrinking. This chart shows the average unit size for all of the units built each year. The rapid increase in size in the late 1930s, that's the A on the graph, is from the creation of the first garden court properties. And the rapid decrease in the early 1950s, that's the B on the chart, is from the creation of the motel-style properties you see dotting our neighborhoods. Except for these two anomalies, apartment sizes generally ranged between 500 and 600 square feet between 1900 and 1960. Then they grew steadily, peaking at 930 square feet in 1999. Units have been getting smaller since then. The average unit size in new properties opening this year is just 812 square feet. For properties opening next year, where we have unit mix information, the average is just 750 square feet. Developers are not only changing the product, They're ramping up production, planning to open almost 36,000 units between 2012 and 2017. And it seems like another proposed development pops up almost daily, because in addition to these 36,000 units, we're also tracking sites that could hold another 19,000 units that got backburnered in the recession. Will all of this development happen? No. Will it all fill up? Yes. It will fill up for two reasons. First, developers will do whatever it takes to fill them. Concessions, freebies, lower rents, whatever it takes. But there's a second reason, as long as our economy holds up. Gen Yers are growing up, reaching the age where they become housing consumers. For the past dozen or more years, we have been identifying Britney Spears as the beginning of the Gen Y boom. She was born on December 21st, 1981, and we estimate that Gen Y started 29 days later on January 1st, 1982. Britney turned 20 in 2002, and the chart shows that's really when the 20 to 34 age group started growing again. Note that they grew significantly in the late 1980s. That's the tail end of the boomers. They shrunk in the 90s because Gen X was half the size of the baby boom population. Now they're growing again. Between now and 2016, our region should add more than 80,000 young adults. People in this age group are typically renters. That is, as long as they can get a job. But Conway-Peterson Economics is forecasting our region will add just over 200,000 jobs in the next 5 years. Most 20-somethings have traditionally been renters, and there are social and lifestyle reasons why they are even more likely to rent now, not to mention the fear of buying that has been instilled by 4 years of depressing news about home ownership. But that's starting to change, which makes this chart important. It shows that the cost of renting the average 2-bedroom, 2-bath apartment in King County compared to the mortgage on the median-priced condo in King County, and it's not a pretty picture, at least not for apartment investors, and it concerns us. Okay, I'm not going to end this presentation on a bad note. Let's talk about the geyser effect. We coined that term 3 years ago when we started looking at how old the boomers are getting. 18,000 people a year turn 65 in our region each year over most of the past 20 years. Over the next 5 years, that number jumps to 34,000 a year and continues to climb after that. The boomers are getting older. So what? Most of them own homes. They don't rent. Why should we care? Well, it matters because this means people will retire out of the labor force faster than ever. That is, once they replenish their 401ks. So it may not happen on their 65th birthday, but it will happen, and happen faster than we've seen historically. This will create a significant and fundamental shift in our workforce, at least for a few years, emptying it of older, predominantly homeowner workers, and filling it with younger, mostly renter workers. I hope you found this overview useful. Remember, our presentation had more details, so plan on attending next year. But if you need more information right now, the October issue of our Apartment Advisor will be out soon. We're going to build on all of these trends and compare sub-market performance. This issue will also dig into all of the new development data that we have to see just how many units we should really expect and where to expect them. The advisor will wrap up with a new 5-year forecast of rents, vacancies, concessions, net operating income, and price trends.